The story of Jesse Livermore is not the story of a man who defeated the market. It is the story of a man who finally learned to stop fighting it. Born in an era where financial markets were raw, unregulated, and brutally honest, Livermore entered trading with nothing but observation and instinct. There were no indicators, no economic calendars, no online communities. There was only price, time, and human behavior repeating itself in different forms. What Livermore uncovered through years of gain and devastating loss was a truth so uncomfortable that most traders still refuse to accept it. Today, the market does not reward effort, intelligence, or opinions. It rewards alignment. In his early years, Livermore believed success came from being clever. He tried to outsmart the market, to predict its next move, to catch turns before anyone else noticed them. Sometimes it worked, and when it did, the profits were intoxicating. But just as often, the market reminded him who was in control. The more he tried to impose his will, the more violently the market pushed back. Losses came not as gentle warnings, but as humiliating lessons. Each loss stripped away another layer of ego, slowly forcing him to confront the real problem. It was never the market. It was him. Livermore noticed something that separated his winning periods from his losing ones. When he made money, it wasn't because he predicted the future. It was because he aligned himself with what was already happening. When he lost money, it was almost always because he argued with price. He would sell because something felt too high, or buy because something felt too low. Feelings, he learned, were the enemy of consistency. Alignment with the market begins with humility. Livermore understood that the market is larger than any individual, any institution, any belief system. Price reflects the collective actions of millions of participants, from speculators to hedgers to institutions, moving capital on a scale most traders cannot comprehend. To think you know better than this collective force is not confidence, it is arrogance. And the market punishes arrogance without mercy. One of Livermore's most misunderstood ideas was patience. He often said that the big money was made not in the buying or selling, but in the waiting. This waiting was not passive. It was deliberate observation. He waited for the market to show its hand, to confirm direction, to reveal strength or weakness beyond doubt. Only then did he commit capital. Most traders enter out of boredom, fear of missing out, or emotional urgency. Livermore entered out of clarity. He learned to identify the primary trend, because trends are where alignment lives. In an uptrend, weakness is opportunity. In a downtrend, strength is danger. This sounds obvious, yet countless traders do the opposite every day. They short strong markets because they feel expensive, and buy weak markets because they feel cheap. Livermore learned that cheap can always get cheaper, and expensive can always get more expensive. Price does not turn because something feels extreme. It turns when participation changes. Letting profits find you is a concept most traders misunderstand. They believe it means doing nothing. In reality, it means doing the right thing and then refusing to interfere. Livermore entered trades with conviction, but once the market moved in his favor, he stopped micromanaging. He did not take profits just because he was uncomfortable holding them. He allowed the trend to pay him over time. This required emotional control that few possess, because watching unrealized profits fluctuate is often more stressful than taking a loss. Losses, to Livermore, were not personal failures. They were information. When the market moved against him, he exited without hesitation, not because he was afraid, but because the market was no longer aligned with his position. He understood that the market speaks through price, and price never lies. Hope, on the other hand, lies constantly. Traders who hope stay in losing trades. Traders who listen get out. Livermore also understood position sizing as a form of alignment. He did not trade every idea with the same intensity. When the market strongly confirmed his view, he increased size. When conditions were uncertain, he reduced exposure or stayed out entirely. This flexibility allowed him to survive periods that destroyed rigid traders. He adjusted to the market instead of demanding the market adjust to him. One of the most painful lessons Livermore learned was that being right too early is the same as being wrong. Timing mattered, but not in the way most people think. He did not try to catch the exact top or bottom. He waited for confirmation, even if it meant entering late. He understood that missing the first part of a move was a small price to pay for alignment and probability. The middle of the move was where consistency lived. The market, Livermore realized, moves in cycles of accumulation, expansion, distribution, and decline. These cycles repeat because human behavior repeats. F. Fear and greed never change. Only their expression does. By studying price behavior instead of news or opinions, Livermore positioned himself ahead of the crowd, not by predicting events, but by recognizing patterns of participation. Perhaps the greatest irony of Livermore's legacy is that his methods were simple, yet difficult to follow. Simplicity demands discipline, and discipline demands emotional maturity. Most traders search for complexity because it hides responsibility. If a strategy fails, they blame the system. Livermore blamed himself, adjusted, and moved forward. Alignment with the market also meant knowing when not to trade. Livermore spent long periods doing nothing, waiting for conditions that met his standards. This restraint protected his capital and his mental clarity. Overtrading, he learned, was not ambition. It was insecurity disguised as effort. In the end, Jesse Livermore's secret was not a pattern, an indicator, or a formula. It was a mindset, a willingness to observe without ego, to act without emotion, and to accept uncertainty without fear. He stopped asking what the market should do and started responding to what it was doing. And in that shift, the struggle disappeared. When you align with the market, trading stops feeling like a battle. You are no longer chasing moves or forcing outcomes. You are participating in a process larger than yourself. Profits no longer feel stolen. They feel earned through patience and respect. Losses no longer feel devastating. They feel educational and temporary. This is why Livermore's lessons endure. Not because markets are the same, but because human behavior is. Technology has changed, speed has increased, and access has expanded, but the psychological foundation remains untouched. Traders still fight price. They still argue with trends. They still confuse activity with progress. Jesse Livermore learned the hard way, so you don't have to. Align with the market. Let price lead. Let time do the work. And most importantly, let profits find you instead of chasing them. Because the market never rewards those who demand. It rewards those who listen. The market has no memory, no emotions, and no obligation to make sense to anyone. Yet every day, traders around the world wake up believing that today will be different. That today, the market will finally listen to their logic. This belief is the silent killer of trading accounts. The truth is harsh but simple. The market is always right, and the moment a trader believes otherwise, the damage has already begun. Fighting the market rarely starts as rebellion. It starts as confidence. A trader studies charts, watches videos, reads opinions, and slowly builds a narrative in their mind. This narrative becomes identity. Once attached, the trader no longer sees price objectively. Every candle becomes an argument for why they are right and the market is wrong. This is not analysis. This is ego wearing the mask of intelligence. Price action is the final judge because it represents real money decisions. Every tick is a transaction where one side accepts defeat. No indicator, no opinion, no theory can override that reality. When price moves against a trader, it is not a debate, it is a verdict. Successful traders accept this instantly. Losing traders negotiate. The most dangerous phrase in trading is "it should." The market should reverse. The market should respect this level. The market should react to this news. The word "should" implies expectation, and expectation creates attachment. Once attached, the trader stops managing risk and starts defending a position. Defense is emotional. Trading requires detachment. Many traders believe they lose because they lack knowledge. In reality, they lose because they refuse to accept what price is telling them. They add indicators to confirm what they already believe instead of listening to what is happening. When indicators conflict with price, they blame manipulation. When price keeps moving, they add more positions. This is not strategy. It is denial. The market is always right because it reflects collective behavior. Institutions, funds, hedgers, algorithms, and governments all express themselves through price. A retail trader with a strong opinion is insignificant in comparison, yet markets are not cruel. They are neutral. They simply move where participation flows. Traders who survive learn to flow with it. Accepting that the market is always right does not mean surrendering intelligence. It means applying intelligence in the right place. Instead of predicting, the trader reacts. Instead of insisting, the trader adapts. Instead of fighting losses, the trader cuts them. This shift changes everything. One of the hardest lessons for any trader is learning to admit they are wrong quickly. Society teaches us that being wrong is failure. Markets teach the opposite. Being wrong is normal. Staying wrong is expensive. Professional traders exit losing positions without drama. There is no emotional attachment, no internal argument. The trade did not work. They move on. Fighting price action often leads to overtrading. After a loss, the trader feels the need to prove themselves. They take low-quality setups, increase size, and abandon discipline. This emotional spiral has nothing to do with the market and everything to do with ego. The market simply provides the stage. Traders who accept price action as truth experience a profound change. They stop reacting to noise. They stop chasing every move. They wait for alignment between direction, structure, and momentum. When they enter, it feels calm, not exciting. Excitement is a warning sign, not a reward. Trends exist because they are reinforced by behavior. When price is trending, it is telling you that participation is one-sided. Fighting a trend is fighting evidence. Yet many traders short strong markets because they feel late, or buy falling markets because they feel early. Timing becomes more important than probability. This is where accounts bleed slowly. The market does not care about fairness. It does not care if you miss the move. It does not care if you need money. It does not care if your analysis was correct yesterday. Price only reflects what participants are doing now. Traders who survive respect this brutal honesty. There is peace in accepting the market's authority. Once a trader stops trying to control outcomes, stress decreases, decisions become clearer, losses shrink, wins are allowed to grow. The trader stops measuring success by individual trades and starts measuring it by process. Price action traders understand that simplicity reveals truth. Complex systems often hide responsibility. When a trader relies on price, there is nowhere to hide. Either you followed the market or you didn't. Either you respected risk or you didn't. This clarity is uncomfortable, but powerful. The market rewards those who listen quietly. It punishes those who shout opinions. Every major blow-up in trading history shares the same root cause: refusal to accept price. Not lack of intelligence, not lack of tools. Ego. When a trader finally accepts that the market is always right, something strange happens. Trading becomes boring, and boredom is a sign of professionalism. There is no rush, no need to be right, no emotional roller coaster, just execution. Price action is not magic. It does not guarantee profits, but it removes illusion. It strips trading down to reality, and reality, while unforgiving, is fair. The market gives everyone the same information at the same time. What differs is interpretation and reaction. Fighting price action destroys traders because it turns uncertainty into personal conflict. Accepting price action turns uncertainty into probability. One leads to emotional exhaustion. The other leads to longevity. The market does not need your belief. It does not need your approval. It does not need to explain itself. It only needs participants. Traders who survive understand their role. They are not heroes. They are observers, participants, and managers of risk. In the end, the market is always right, not because it is perfect, but because it is final. Arguing with it changes nothing. Listening to it changes everything. Markets do not explode into motion without warning. They prepare in silence. Long before price accelerates, long before candles expand and social media wakes up, something quieter happens beneath the surface. Capital begins to shift. Positions begin to build. And those who understand the psychology of big money recognize the SE moments not as boredom, but as opportunity. Big money does not chase price. It creates the conditions that price eventually responds to. Institutions cannot enter markets the way retail traders do. They cannot buy or sell all at once. Their size would move price against them immediately. Instead, they operate patiently. distributing their intent over time, hiding urgency behind calm. This is why markets often feel slow before they move and violent once they do. Retail traders misunderstand this silence. They see consolidation as randomness, as a lack of opportunity. They become impatient. They trade too often, too small, too emotionally. Big money, on the other hand, thrives in these quiet periods. Accumulation feels boring because it is designed to feel that way. The market lulls participants into complacency before revealing its true direction. The psychology of big money is built on time, not speed. Institutions think in terms of campaigns, not trades. Their goal is not to be right on every move, but to position themselves where risk is lowest and potential is highest. They allow price to move sideways while they build positions. When they are ready, they do not ask the market for permission. Their participation becomes the permission. This is why markets often move before news. By the time information reaches the public, positioning has already occurred. Headlines do not create trends, they justify them. Big money acts on anticipation, not confirmation. Retail traders wait for clarity and enter when risk is highest. Understanding this changes how you view volatility. Sudden expansions are not chaos, they are release. Pressure built during consolidation eventually demands expression. The longer the market compresses, the more violent the expansion becomes. Big money knows this. Retail traders fear it. Emotion peaks at the worst possible times. At market tops, optimism feels rational. At market bottoms, fear feels logical. This is not coincidence, it is psychology. Big money distributes into strength and accumulates into weakness. Retail traders do the opposite because emotions guide their decisions. Institutions also understand perception. They know most traders rely on obvious levels, common indicators, and shared narratives. Price is often pushed beyond these levels to trigger emotional responses. Stop losses are not hunted intentionally, they are simply predictable. Big money does not need to target individuals, it only needs to act logically in an emotional environment. The market moves in phases because behavior moves in phases. Accumulation transfers assets from impatient hands to patient ones. Expansion rewards patience. Distribution transfers assets back to the crowd. Decline punishes late participation. These phases repeat not because markets are mechanical, but because humans are predictable. Retail traders often ask why they always enter too late. The answer is simple. They wait for certainty. Big money acts in uncertainty. When certainty appears, opportunity is already passed. Price feels safe only after it is moved. Patience is the weapon of institutions. They can wait because they are not emotionally dependent on individual outcomes. Retail traders attach identity to trades. A win feels like validation. A loss feels like failure. Big money feels neither. It executes plans. When you align your thinking with institutio, Nal psychology, trading slows down. You stop needing constant action. You stop reacting to every candle. You begin to respect consolidation as preparation rather than punishment. Sideways markets no longer frustrate you. They inform you. Big money also understands that not trading is a position. Silence is a decision. Many of the best opportunities come from waiting while others force trades. The market rewards restraint because restraint preserves capital and clarity. Retail traders often believe they are competing against institutions. In reality, they are competing against their own impatience. Big money does not care about retail participation. It moves based on liquidity and objectives. Retail traders are simply liquidity when they act emotionally. The most dangerous belief in trading is that the market owes you opportunity. Big money knows opportunity is created through preparation and patience. Retail traders demand excitement. Markets punish demand. Price structure reveals intent long before direction becomes obvious. Compression, failed moves, shallow pullbacks, and persistent pressure are signs of accumulation or distribution. These signals are subtle. They require observation, not prediction. Big money watches. Retail traders react. When expansion finally arrives, it feels obvious. Everyone sees it. Everyone talks about it. That is when risk is highest. Big money is already positioned. Retail traders are chasing. Understanding big money psychology does not mean copying institutions. It means respecting the environment they create. It means trading with awareness instead of urgency. It means entering when emotion is low and exiting when emotion is high. The gray test edge a trader can develop is not speed, leverage, or information. It is patience. Patience allows clarity. Clarity allows alignment. Alignment allows consistency. Markets reward those who understand that movement is prepared, not spontaneous. They punish those who believe every move is an invitation. Big money waits. Retail traders rush. When you stop trying to be early and start trying to be aligned, trading changes. You no longer feel surprised by market behavior. You expect consolidation. You anticipate expansion. You respect decline. The psychology of big money is not secret. It is ignored. It is uncomfortable because it demands discipline. It demands waiting when others act. It demands acting when others hesitate. Most traders lose not because they lack strategy, but because they cannot wait. They confuse activity with progress. Big money understands that stillness is power. Markets move before you notice because attention follows movement, not preparation. By the time the crowd notices, the work is done. The transfer has occurred. The opportunity is past. If you want to survive markets, stop reacting to noise and start observing behavior. Stop demanding action and start respecting process. The market does not reward urgency. It rewards patience. Big money knows this, and now so do you.